Hi, my name's Salman Ahmed, and I'm a portfolio manager and partner at Steadyhand. In this segment of our 2021 Where To From Here, we're speaking with Joe Sertivan at Magnus Larsen. Joe is the CEO of Galibier Capital. He manages our small cap equity fund. Magnus is the head of international equities at Times Square Capital, and he manages our global small cap fund. Now, as the names might suggest, both these funds invest in small companies, but Joe's fund is Canadian-centric in nature, while Magnus has a latitude to invest anywhere in the world. Now, we're big fans of investing in small businesses around the world, small cap stocks that is, and it's reflected in our Founders Fund, which has 14% invested in these two funds, and the Builders Fund, which is our more growth-oriented fund, which has 30% invested in the small cap and global small cap fund. Now, I know I've just talked up small cap investing, but the truth is that investing in larger companies has proved to be better over the last 10 years. If we take just the US market as a proxy for this, the US large companies have outperformed small companies by more than 20% cumulatively over the last decade. Now, Magnus, I want to get your perspective on this. You invest globally. Now, Times Square, and you have done very well through that period. But maybe tell us why, in general, large companies have beaten smaller companies, because research and even general consensus is that the opposite should have been true.
You're right, Salman. If you just take a simplistic view, you can say that large caps have outperformed small caps over the last 10 years, and even more so, especially the last 5 years. But I would say that some large caps have outperformed small caps. If we take away the FANGs, the famous FANGs, and we look at S&P 495, i.e. we take away these high-flying names that we all know about, in fact, the rest of the S&P 500 has underperformed in both the 5 and 10-year period. So all of the outperformance is coming from a very small number of names.
Now, a lot of the FANGs that you've talked about, Magnus, are technology names. Facebook, Amazon, I know it's consumer, but it's got a big technology bent to it, of course, Microsoft and Google, etc. You're not averse to investing in technology yourself, but you haven't invested in, let's call it, the market darlings yourself. Maybe you can walk us through why.
Well, it's mainly a matter of valuation. A lot of these darlings have, in our view, a valuation that is not grounded in the economic reality of the businesses. We have found better value in adjacent technology areas. So for instance, some of our bigger holdings in the portfolio right now will be Nordic Entertainment. They are the leading streamer of video content in the Nordic area. They were in effect Netflix before Netflix even existed. They have a very strong market share. They have the dominant sports rights. They also have all the Hollywood content, and they also produce their own content. And as we know, what is called linear TV is becoming less and less viewed. The days of I have to watch the show because it's 8 p.m. and I have to see it, they are over. Today, we want to consume media when we want it and where we want it. And that's where companies like Nordic Entertainment are doing so fantastically well. Another company that we like a lot is Zynga. Zynga is a specialty company developing games mainly for mobile phones, smartphones. And it's just a fact that we might have shorter commute times these days, working from home, but we certainly have more times on our hands. And we have seen that during the COVID pandemic, we liked Zynga before, and it certainly has benefited when people spend much more time on their smartphones. And we have seen also in areas where the close downs and lockdowns ended, people still, after the lockdowns, kept spending a lot of time on their phones. And Zynga is a great beneficiary of exactly that.
Yeah, for sure. I guess instead of having a glass of wine with friends, we're now playing Words with Friends a little bit more, and which Zynga produces. So I can see why there would be a surge in demand there. Joe, investing mainly in Canada, you've got a slightly different challenge. We don't have that breadth of technology or maybe even technology-related companies here, but you've got a situation where 40% of the small cap market is invested in resource companies, energy and materials, businesses that you generally don't like. So maybe you can tell viewers why you tend to stay away from these resource type of businesses and maybe why an exception might be made if you do make one.
No, that's exactly right. I mean, not to reiterate our investment philosophy and process, which I know your viewers have heard about over the years, but we really do try and only own companies that have enduring competitive advantages and have very, very strong ESG practices. And we just don't find a lot of companies in the resource space that meet those criteria. So we tend to underweight them. But occasionally we come across something that both meets the test of an enduring competitive advantage. In a resource company, that's going to be the low-cost producer with a balance sheet that has the ability to sustain a prolonged period of low commodity prices. And here I'm talking about oil and gas or gold or forest products or base metals. And then beyond that, it has to meet our valuation test, which means that it's trading at a significant discount to its net asset value. And we calculate net asset value basically using our view of mid-cycle pricing for commodities, and that's based on global cost curves. So we'd be using $40 to $50 oil WTI price right now in our calculation of net asset values for oil and gas stocks. And actually, we don't own any oil and gas producers right now. We do have some exposure to the oil and energy index through our holding in Parkland, which is an operator of gas stations and primarily actually convenience stores with gas pumps in front of them. And that's a very well-managed company with very good growth prospects, but it's really not tied to oil and gas production, more consumer consumption of oil and of gasoline products. The other place we have some exposure in the fund and resources is Interfor, which is a lumber producer. Actually, we almost view lumber as and in forest products in general as almost a renewable resource. And so it actually meets our environmental test on our ESG criteria. And also the prospects for lumber price look very strong right now. And actually we're very fortunate we're able to buy Interfor as cheaply as $6, $7, or $8 right now. It's trading during the year on the pullback associated with the COVID crisis. And now it's around $23 or $24. So it's been a good performer for the fund. We've actually been trimming our position in Interfor. And then the other place we have resource exposure is in gold mining, and that's through our holding in Torex. We bought that at a significant discount to net asset value using $1,800 gold. We think it's in a safe geographic area. Its operations are in Mexico, near Mexico City. So we're not taking on a lot of political risk in that name. And it does give us exposure to gold, and we like gold, both in the case of Torex because of production growth. We also like the commodity due to some concerns about fiscal monetary policy in the last little while in response to COVID, which is, we think, potentially going to lead to some inflationary pressures down the road.
Now, Joe, I want to stay with you for a sec. You staying away from resources in general has been just fine for us. Your record speaks for itself. Your fund is up, more than 34% since you took over the fund. Cumulatively, the index is up a little more than, I think, 13%. That's 1.3. So you've done very well for us. But one of the keys to that success has been industrials. And it really jumps off the page. Almost 50% of the portfolio is invested in industrial companies. And that might surprise some people when they're looking at it because when they're thinking about diversification. So maybe you can address that.
That's right. I mean, in terms of names held, we own about 25 names right now in the fund itself, and 10 of those are within your classification of industrials. And I guess, that does seem like a lot. It's 40% of names, and I should say more than 50% of value. But really, it's a collection of very disparate businesses. I mean, we have companies like Badger Daylighting, which provides excavation services. We have Boyd, which provides auto repair services. We have engineering and construction companies like SNC and Fluor. And then we run the gamut all the way down to Savaria, which is a new addition in the fund. And that gives us exposure to home healthcare products like home elevator systems, home lifts, wheelchair accessibility into vans for home use. So that has a good demographic kind of element to it as well. In a sense, it will benefit somewhat from people perhaps delaying or not putting their aged parents into long-term healthcare facilities as a result of COVID. So we have a very disparate group of industries represented in a very broadly defined industrial sector in the index. So that's really the answer to that question. But all those companies meet our test, which is that they meet our 5 criteria. And just to review, that would be an enduring competitive advantage, exposure to very high growth potential in its industry. We're looking for companies with, as I've already said, very strong ESG elements. We're looking for businesses that have high free cash flow and balance sheets with an appropriate for the industry level of financial leverage. And if we can meet, we find a lot of names within that sector that meet those criteria. And then the trick then is to value them proactively and then take advantage of market pricing to make some moves. And that's what we've done this year. Well, I think maybe we'll talk a little bit later about some of the moves we made over the year, but the industrials were well represented there.
Thanks, Joe. With Magnus, your portfolio, I want to ask about financials. It's something that in our conversations you've told us you're very excited about, which might sound odd to Canadians, because when Canadians think of financials, we think of big banks, certainly not smaller companies. So walk us through the kinds of financials that you're investing in, and what has you so jazzed about them?
Absolutely. No, we are excited not only about financials, but certainly we have a number of financial companies around the world that we are excited, and one of them would be Fineco Bank in Italy. Now, banks, generally speaking, are dull, not fast growing. They are challenged from regulations and technology investments, which is exactly why newer banks, without all that luggage and the past with them, can grow much faster. They have scalable technology. They don't have any offices they have to worry about. I used to kind of joke back in the day that the incumbent banks, they have offices and branches everywhere, and only the employees go there. And these days, not even the employees are going there. So that means that these kind of banks that are challenging the incumbents are much stronger, growing much faster, and the roadmap to future growth for them is very, very long, because as in Canada, in most countries around the world, the old incumbent banks are still sitting on the lion's part of the market. But the growth is all coming from these smaller, more nimble, technology-driven companies. Other names that we would certainly put into this bracket would be Renaissance Re. It's a reinsurance company, or in other words, they're an insurance company that insures other insurance companies. These are especially, focused on catastrophes, big events, terror. So anything from a terror attack to a storm, to an earthquake, forest fires. And unfortunately, as we know, the climate change is meaning that and resulting in more of these events. And that is where the specialist comes in. They have an ability to price this risk much better than individual insurance companies. So RenRe probably have the biggest database of doom and gloom in the world, and the ability to actually sell that to other insurance companies. So these are more smaller, specialized companies. We also have Steadfast in Australia, that is an insurance broker. Now, Salman, if you want to have a car insurance, you can just go online and go to a comparison site and plug in, where you live and what car it is, and boom, you have a policy. Or if Joe would be the head of a global company like General Electric, they have specialists that cares for them. But if you have in between an SME company, they are too complex for comparison sites, and they are far too unimportant for the really big insurance companies. So they need these brokers to specialize and put packages together. So this is kind of a smaller niche areas, not competing and doing what the big boys do, but doing what they do is very profitable.
Oh, thanks, Magnus. For the last couple of questions, I want to take a step back a little bit. We are in this very uncertain environment. You talked about insurance a second ago, Magnus, and it's reflected in some of the premiums that people have to pay. But just in general, there's this uncertain environment. And as investors of smaller companies, how do you get some kind of certainty, or any certainty at all, about the potential of these businesses when there is just so much unknown about what the next few months is going to present?
Sure. So, obviously this has been a test in the last year with the market volatility of our investment process. And really, our investment process seeks to control 2 elements of uncertainty. The first is business risk, and the second is price risk. So how do we do that? Well, we only look at great businesses, which are defined by meeting all 5 of our criteria. And then secondly, we proactively value them. And to proactively value them, we forecast our earnings, cash flow, and balance sheet 3 to 5 years into the future under a normalized set of economic conditions in the future, a normalized and reasonable set of economic assumptions about the future. So we kind of look through the near term and focus on the long term and let the competitively advantaged companies that we have in our investment universe work for us. And so that's really how we manage uncertainty. And really, we demand a big margin of safety in our valuation work. We assume relatively high 12 to 15% discount rates on our as we calculate our intrinsic values. We use a conservative view of future earnings power of these companies. And most importantly, though, we only look at businesses that we believe we can project the future in with a high degree of certainty. So that's how we control uncertainty, is we kind of try and use a lot of analysis. And secondly, in terms of what this has resulted in this year in 2020, I mean, in the first at the end of the first quarter, obviously we had the shutdowns, we had a collapse in markets, and a lot of stocks fell to incredibly attractive levels. And we actually, bought a number of new additions to the portfolio in the first and second quarter. Two that I'd like to highlight are actually both names that we've held for Steadyhand in the past, and that would be Boyd and Badger. Actually, sorry, only Badger. Boyd we owned elsewhere, but we now bought it for Steadyhand. So Boyd we paid $138 for. It's currently at $222, and Badger we paid $29 for, and it's currently at $38. So our process, worked on those, and we made a number of other additions and a number of adds as well over the years. So it's in many ways, if you have a proactive view and valuation, you have a universe that you have a high degree of confidence in the quality of the business models. Mr. Market's pessimism or optimism can be quite lucrative if you're willing to act.
Magnus, I want to ask you a question, and staying on that theme of uncertainty. What's an investment risk that investors aren't paying enough attention to right now that they should?
I think that a lot of the risk in the market right now is in the passive part of the market. Money has continued to flow in, and as you know, passive funds are valuation agnostic. So a lot of capital has ended up in those very FANGs that we discussed earlier, and has chased a lot of valuations up. So I think people think they're diversified when they have passive funds, but are not necessarily so, which could actually turn quite nasty should we see a significant weakening of the economy and outflow.
Joe, I want to end on a positive note, and I'll give you the last word. What has you most excited about the current investing environment? Because there's certainly a lot of, like we talked about, the uncertainty, but there's also some opportunities there. So what are you most excited about?
Well, it's been an incredible 20, and we're expecting a very different and hopefully much better 21 as the vaccines roll out and people's ability to move about and, return to commerce begins to take hold. And so we're looking for some of the companies that we think are going to benefit significantly from, secular changes in the way commerce is undertaken. Think of Cargojet, for example, a company we hold that is a provider of overnight cargo haulage across Canada and actually to some degree now internationally. And they are going to benefit massively from both the vaccine rollout, especially the fact that the vaccines have a short life and require special handling. So air transport of the vaccines is going to be paramount, and Cargojet could not be better positioned there. And then longer term, I think the growth in online retailing and online and courier fulfillment is going to be a secular shift in the economy. I don't think people are going to be going back to the malls at the level that they were in the past, and so that benefits Cargojet very well. Its major partner is Purolator, but it also has a direct equity ownership by Amazon in Cargojet. So its partners are blue chip and are very well positioned. We're very excited about Cargojet's future from here, for example. So yeah, we're onwards and upwards. We're very hopeful about things.
Well, thank you, Joe. Thank you, Magnus, both for participating. As someone who's personally invested heavily in both your funds, I'm hoping for the continued success. And again, thank you for your comments. And thank you all for watching today. If you haven't checked it out already, there's lots more content for our annual Where To From Here presentation on our website. And if you are new to Steadyhand, check out our website, steadyhand.com. Thanks again.